Just stay still.
Welcome to The Real Deal. We're going to talk about something that everybody does, whether it's catching a falling knife, standing in front of a moving freight train, or just buying the dip. And we always talk about, oh, I like this as a dip buy, bull market, the stocks only go up, buy the dip, get yourself a better price. But remember, when you're buying the dip, stock's going down. Pressure is against you. It is not going in your favor. You are not with the short-term trend. So you've got to have yourself a set of rules so that you don't always get run over. Truth of the matter is, there is no such thing as buying the dip without occasionally getting run over. It's going to happen. But what can you do to limit the amount that you lose when you are wrong? And how can you still be in those dip buy trades when they eventually rip? Because, hey, if the market's usually going to the upside, you want to be able to take advantage of. Okay, so first off, I mean, what is buying the dip? I think it's pretty obvious. It simply means that you are looking to engage in an upward trend, but by buying a reduction in price. Now, the most extreme example and what I'm going to focus on today is at 9:30 at the open, where you often get the most bamboozlement, where you get the biggest flushes. So I'm going to use one example of what it looks like that we're all hoping for, and then we can get into what it looks like when it's dirty. So have a quick look at Rivian here. Now, I'm not showing you today on purpose. So yesterday, the day before this, you have an obvious dip at the open. It kind of hammers the $15 even level, which had been good for Rivian, makes a wick bottom. Look at all the strength. Okay, so the first thing I always lock into when you get a hammer bottom like that is, where are the key levels? 1475, 1485, and then the higher low at $15.10. So what is it going to look like for me, fast forward to the next day, if a similar thing happens? Well, I'm going to want to buy the dip at 1510. If I'm going to want to buy the dip if there's a level holding at 1485 and 1475. So what this looks like when everything is perfect is it dips at the open, goes to the level, and bounces right off your level. Great, fine. But here's what you need to do if it's not going to happen for you. If I'm long and I like this level, but I also think it can be good at 1485, and I also think it can be good at 1475, you got to pick one of two lanes. Lane one, which is my preference, if I'm in here and it can't hold that local bottom, get out. If I like it down there, allow it to get to that price, try again. If it breaks, get out. If I like that bottom, jump in that other time and take 3 separate trades and get out. And the value of doing it this way is, if the range is still going to remain somewhat similar, if you end up getting out there, take your hit, get in a better price, because you were getting closer to the bigger support level and giving yourself a wider range the farther it goes down, you can then say, okay, well, if I like it for X here, I like it for 1.5X there, I like it for 2X there or 3X there. Because you're getting maybe tighter stops, you're getting a better price with a bigger move, but you're taking the small hit so that you can jump in again at a bigger price. That's path number one. You can always go that route if you want to. I prefer it. The other way to look at that would be, do I simply want to get in a little bit here and then average into the bottom? If you choose that dollar cost average method, you've got more math to do in front of you. Because I can say, if I want to risk 10% of my daily risk limit here, I can get in, have 5 cents worth of risk, pick that number, and then it's really easy to do. If you're going to hold and average in 3 times, you've got to determine how much do I want on that break of the bottom, and then work backwards from there. Okay, well, if I want X amount of shares on the break and I only want to lose $1,000, whatever it might be, you then have to carefully calculate, how much can I buy there? How much can I buy there? How much can I buy in front of that bottom to get myself the right average price? It's a little bit trickier to do in advance. But if you know I'm willing to get in and out, willing to get in and out, willing to get in and out, that's a safer way to go about it. So what does it look like in the wild when it doesn't necessarily always work out for you? So I'm going to go over to Snapchat. That was another buy the dip type of plan. And if you want to approach things in the I'm going to get in, get out type of mode, what works here is, if you have yourself an out, and that's going to be the key. If you have yourself an out, it's going to work out for you, especially when things are moving so fast that having a dollar cost average plan in place, like I was talking about, is going to be tricky, but jumping in and out is going to afford you better opportunities when something is doing outlandish volume. So ignore, this is not really a buy the dip, like it broke out a local high. Let's start thinking about what happens here at the open. You're looking at the pre-market bottom, long into the pre-market bottom, it never breaks it. So you get some long 85s, get some long at 12 for an average of like 90s. That you can have to your plan. You're risking 20 cents to the bottom. The second it goes 20, 25, 30 in the money, you're taking profit. When it pulls back in, I can reload knowing exactly where my entry, roughly within a cent or two, is going to be off that low. And then plan that action on the way back up. Now, one thing to consider here, and I'm going to give you on the fly one adjustment. As it's making lower highs, this is up to you, I want to be risking less. So if this was making the exact same range, and if I think you take the same amount here, I might take a similar amount there because I have a tight risk stop, and I'd take a similar amount there. When it's making lower highs, then I want to risk less going into it. This is the advantage of getting in and out on the same dip buy off the same level where you don't necessarily have to worry about averaging in. It breaks a low, I get out, it wicks the bottom, I try to get back in, and I get right out. Find another level, get in, get out, get in, get out, get in, get out. Limit the loss. Take the hit when it breaks the bottom. That way, you're not maximum in all the way down, averaging when it takes out that low. You always want to try to have a comfortable trade if you can and not be panicking on the way down and adjusting on the fly. So it's really important that you pick that path. Because if you do decide that you want to, I like 3 buy levels and I want dollar cost average in, that requires some planning, which for experienced traders, probably not that big of a deal. But for a novice trader, it's going to be a little bit easier to just take multiple cracks at it if you have to, and always have that tight stop. And when it breaks it, just get out and reestablish a little bit lower if that's what you have to do. It doesn't really make a difference where you do it. I was buying the dip on Ford today. I'll give you another example of this. Ford, oh, why did you like 1245? I can't figure out why. So you go to the higher time frame. I like the dip buy at 1245. It was breaking out on earnings. On the daily chart, you've got 1245 right here is the most local resistance level that I think can turn into support. You've got another one right here at the 200 period moving average at 1220. So I like 2 levels on Ford, 1245, 1220. There's a couple of ways you can trade around that. Now you can get in and average into it, or what I elected to do, which was get in when it breaks the local bottom, my 45s are out. And when it gets to the 1220 level, I just make a separate trade off that 1220 level. And now you can sort of see it actually holds the 1220 level better, which is fine. But you've got to pick which lane you're going to be in. You cannot be going back and forth. Either you are the type of trader that is going to take multiple shots at buying the dip with a stop out, or you're going to be the trader that carefully is able to dollar cost average in to your stop level and then be able to get the hold all the way back. Now, if you're going to do part one, you're going to be a little bit more risk averse. You're going to limit your losses a little bit better, but you are going to miss some moves. Because if you get out, it doesn't get to your next level, you might miss the bottom again. But that's the cost of doing it that way. You're going to have less big losses, but you are going to miss out on some of those best dips if you choose this approach of take your shot, get out, take your shot, it works. But hey, if it wicks that bottom, I'm out. Maybe I don't get back in. If you do the dollar cost averaging side of it, you're going to catch pretty much almost every single move unless it breaks that bottom level. But it's going to be incumbent on you to be able to hold it, not just on that first bounce. You got to be able to hold it further because you've been buying all of the way down. That requires a plan of action as to how many shares you want in total, what your average price should be, and then ensuring you hold a sufficient enough portion of that trade when buying the dip. It's much more complicated to do it that way. But it can yield great results because you're not going to miss very many bottoms. It's all about picking your lane. We always say you cannot control what the market is going to do, but you can control your preparation. When you're buying the dip or getting in front of that falling knife, you've got to determine what type of a trader you're going to be. Are you going to be a little bit more risk averse, take those paper cuts and take your outs and try again and try again? Or are you going to be someone that's going to buy all the way down into your level, have a plan for it, and then be able to hold a bit bigger? Once you know who you are, who you want to be, then it's easier to structure your trades. Because if you're going back and forth, reality is you're not picking a lane and you're going to be all over the place, and it leads to losses that way. Because you're going against the grain when you're buying the dip in that moment, and if you don't have a plan of action, you're going to get burned. That's the real deal. Everyone wants to buy the dip, but you've got to understand how you are going to do it successfully, because there's more than one way, everybody.